Good morning, it's Dennis Woolman with the Active Trend Traders, How to Make Money Trading Stocks webinar that we do every Friday, except we're not going to do it next Friday because we'll be moving into the new year. And my wife and I are going to just take a little bit of time off, but I will still be posting emails and alerts as necessary. I want to remind everybody that all the materials that we do present are for training purposes only, and traders should always paper trade any new method prior to the risk of their own personal capital. Michael is not with us today. He has traveled back to Austria to see his folks for Christmas, and so we hope he's having a great time. And talked to Mike Traeger yesterday. I think he's going to be out playing tennis today. And so things are winding down with only 4 more days left after today, 4 days of trading left in 2016. I want to show everybody just real quick a couple of things I'm looking at right now. I'm really liking LABU. It's the 3-time leveraged ETF for the biotechs. It basically has found support down here, and it's in this little downtrending channel, but it's found support and is rebounded today very nicely. It's got some good positive divergence going on. Here is a downtrend line. It needs to get back above that and or the 8-day moving average, which is here, but it is about it's about 10% down to the lower level below the swing low. So, if I was open position, I would size it appropriately so I'd never have more than a 5% loss on it. But it's not, it's just basically posturing for a potential rebound. I'll be taking a look at that. The other one we'll be taking a look at is Nugget. Nugget is also showing some, at least on a weekly chart, as we see over here, showing some, not necessarily, well, a little bit of positive divergence in the momentum, but still moving kind of sideways. But it's back down into the zone of support that it met last year, and maybe setting up for a bounce. It too needs to get back above its 8-day moving average, which is at 637, and so might be worth a nibble, in the near future if it retests down about 6 and then bounces back up through it. But the miners may be ready for a little bit of a bounce, and so those are 2 of them that we're watching for next week. And I'm not going to open any, I don't think I'm going to open anything today, just simply because going into a 3-day weekend. Remember, the market is closed on Monday for the regular Christmas closing. Since Christmas is on Sunday this year, they'll be closed on on Monday, all the markets. And then also following that, the following week after the New Year's, markets will be closed also on the 2nd of January 2017. Here's a little bit about me for those of you who may be joining us for the first time. You can go back and review that. And so one of the things that I really emphasize and really try to provide is good quality and high quality trading on Wednesday nights to all our premium members who dial in. And if they don't get in on the live webinar, they can always they always have access to all the training that we've done since we went live about 3 years ago now, and so there's well over 100 different videos of training that we've covered in that time frame. The first topic we're going to cover in 2004 will be January 4th, which is the first Wednesday in January. We're going to be talking about how to profit from seasonality. We're going to talk. I'm going to be talking about seasonality in gold, seasonality in oil, and also seasonality in the IBD 50 list for small cap, not small cap, but growth stocks. I've been now monitoring, studying the IBD 50 for the last 10 years, and there is definitely a seasonality to the movement in those stocks. And going into 2017, we are looking forward to some explosive growth in the area of seasonality. So what about this week? What's going on? You know, the question of the week, I kind of like, this week was kind of like, maybe it was like holiday leftovers. Not a lot of movement, not a lot of just kind of stuck in a range, moving sideways, kind of quiet. But remember, there is only 4 more days of trading. And the last week of the year historically is up somewhere between 1 to 1.5%. We'll see if that continues into next week, if the historical precedence is followed. The S&P, all I can say about that is it is slowing, consolidating, you know, or is it ready to do a little bit of a pullback? NASDAQ, I think of all the 3 tracking indexes that I track, the NASDAQ 100 is probably most likely to do the most significant pullback, but that choice there is closely followed by the Russell. The Russell really hasn't given us a really good pullback, considering that the Fed raised rates. And so it may be increased interest rates is one of those things where the small cap stocks, which typically have you know, higher percentage of, you know, borrowed money, if they have to borrow more money, higher rates impacts their bottom line. So outside and earning influences, of course, we'll be getting ready to go into earnings about midway through January, so nothing for that right now. But I find it kind of interesting that we had several terrorist attacks, you know, this week. You know, in Germany, one that was thwarted down in Australia, and several. But we've had these terrorist attacks. They may call them lone wolf attacks or whatever. But there's been very little, if any, noticeable effect to the indexes. Then secondly, in all of the index are overvalued at this particular point, but again, no real effect on the market. It hasn't been a negative to it whatsoever. Same thing on the 7.5-year bull market, you know, almost 8 years worth of bull market that we've you know, had, and the market is still continuing to move, you know, make all-time highs and this type of thing. So the current uptrend. So the current uptrend is, you know, with the current uptrend, I'll be looking to trade the pullbacks until they don't work. I mean, that's basically all we can do on that. On this overvaluation item, it's kind of, I won't say it's like a stealth type of clue, but it's something that we, you know, need to at least be aware of, because with the markets being overvalued, you know, if any weakness comes into the market, that could exaggerate the downside and make a fall off more severe and more quick. But at this point, no real effect. We have not seen any really strong indications that a pullback is in the offing. So let's go over here, over to the percentage of stock above the 20-day moving average. As Mike and I've mentioned several times, what this is starting to show us now, well, one is we're primarily interested in when it's down here below the 30 level, and if it's down below the 25, down all the way to the 5 or so, it even becomes more interested for potential rebounds. And this is one of the initial indicators we utilize for the early warning alert service. What we can see here is the stocks of the NYSE are in fact pulling back. You know, fewer of the stocks. It's down to about 57.91 as of this morning. Percentage of stocks that are above that 20-day moving average. As you can see, though, while fewer stocks are participating in the rally in the NYSE, the S&P is just basically kind of maintaining. I mean, it's come up, it hit its high, dropped back, and now is this, and this is a reflection of the spiders, which is the index ETF for the S&P. And as you can see, we hit its high, came back, and now it's just kind of moving sideways. Moved up a little bit here into a potential lower high. However, this support down here at about the 225 level has in fact held, and as long as that holds, we can anticipate possibly a bounce back up into these areas. Will that happen next week? You know, we'll see. If we break down below this low here, we can anticipate a more significant pullback, maybe back to the 30, you know, the 1/3 to 2/3 level if we laid a Fibonacci, you know, between here and here, from these lows here up to these highs here for anticipated pullback, and that would be a normal, natural pullback as observed by Charles Dow back in the late 1800s. So that's what we've got going on here. Nothing really to report. We'll be watching this for when it gets down into this area. But right now it's just telling us that the NYSE is weakening as the index, like the spiders, which is a weighted index, is kind of holding its own. It's not really retreating much at all. So here's where we sat as of first thing this morning, or 9 o'clock this morning. The indexes had pulled back a little bit, but now they're just kind of they've kind of stagnated where they're at, and not a lot of movement, you know, going into the, you know, the 3-day weekend. Let's take a look at the charts really quick. So, okay, let's cover this really quickly. Here's the S&P. It went up, ran up, made a new high. TSI made a new high. However, as you can see, the momentum did not, but the momentum did peak up a little bit higher when it pushed up to retest in this area. But we're still getting some negative divergence on the momentum, negative divergence on a weekly chart. If you know, if the price action closes at current levels or even lower, then we would have basically 2 weeks worth of spinning top dojis, which is a clear candlestick indication that we of not necessarily weakness, but of indecision. And it would be also, this week's would be a small shooting star type of candle. And the other thing that I noticed is that, as you can see, this week's range is well within the range of last week, and so it would be considered what is called an inside week. Then that often can be indicative of a pullback that's in the offing. If we open lower next week and take out the low from this candle here down at about 2247, then look for a pullback back in here to the 22, at least 2213, this past breakout area. But let's lay a fib on this really quickly. And I'm going to lay the fib from here to here to get an indication of where things might pull back to. And as you can see, hide that. Right now we're looking at it's pulled back about to the 23.6 level. It did the same thing over here when we moved from here up to here. It pulled back about 23% of the run. Normally that's considered it either shows strength in the index or it shows that the uptrend will continue because you're not getting a full healthier pullback, which would be back down here in the 38.2 to 618 retracement area for our rebound off of there. Notice the difference though between the current pullback and the one from a couple of weeks ago. This was just basically a nice symmetric pullback down into just below the 8-day moving average. This one, the range of the pullback is about the same on that 1 day, but then we pop back up quickly. However, after a little bit of a rally, it did not push its way back above this level. So the rally that what they're calling the Trump rally has in fact stalled, at least temporarily, in this location. And so we've got some resistance up here at about the 2277 level, and we have a level of support that's right there about the 2248 level. If we get a break either way, we can expect at least a run of that much. If it breaks down the bottom side, we expect a run of at least, let me get rid of that. If we break out the bottom, we would expect a run of at least about 29 points to the downside, and that would put us at, if we did get that kind of a run, that would put the prices back down at about 2220, which is just above this past level, where it broke out. The breakout support is there. So that's what we're seeing with the S&P. Again, the TSI on the weekly has not rolled over yet, but it is negative divergence. Momentum has rolled over a little bit, and we're getting some, it is also, showing some negative divergence. NDX. Okay, the NASDAQ for the past week, over the past almost 2 weeks is stuck in this range between 4962 down to, let's say, 4900, which would be here. It's stuck in that range. It is maintained its, since the 2nd of December, it has maintained itself above the 8-day moving average, and we're not getting a close below it, but it is extended from both the 20 and the 50-day moving averages. The indicators themselves are showing that they are rolling over. The TSI has, in fact, the fast TSI has gone below the slow TSI, and for some who are triggering off of the TSI, that would be considered, if you're long a position in like the Qs, or in the case of TQQ, it'd be time to either take your profits off the table and or at least take partial profits. Same thing over here. Definite strong negative divergence on the TSI on a weekly basis, and as you can see, the momentum on a weekly basis is just driving sideways, even as this is pushing higher. You can really see on the weekly chart exactly where that level, that higher level of resistance is, and the about there, let's lay it in there, and what we can see is with the longer upper wicks, that's telling us that that's where sellers are coming in, and they successfully push down prices 2 weeks in a row. But it's pushed it down, but things haven't let go to the downside. So, Tracy, have a great Christmas, man. And you can catch the recording later. One of our friends needed to bug out a little bit early. What about the Russell? Okay, Russell, on the other hand, indifferent with the other indexes, has in fact, moved below its 8-day moving averages and is holding below it as we speak. It started showing additional weakness more quickly than the other indexes. and but it's working kind of on this little pennant type of formation. And oftentimes after a big run-up, there's a very good likelihood that it's going to break up through the upside and take off and go higher. But if it does break down through the bottom side, it's got some good support there at about the 1347 level. And on a weekly chart, though, it looks like it basically, the TSI has not crossed yet, but it's really close. And the momentum has, in fact, started pointing down. Now, will we get any acceleration next week is the question we'll be waiting to answer. So for now, that's what's going on with the indexes. Let's take a real quick look at both the composite, the NASDAQ composite, showing very similar to the NASDAQ, but it looks like it could, if it drops a little bit today, it could actually close below the 8 on a daily chart, and it too is showing a currently it's showing a shooting star type of weekly candlestick, which is telling us that the upward momentum is waning. And the other one we like to take a look at, because it is, not a leveraged or not a weighted index, is the NYSE. NYSE, as you can see, it looks a lot like what's going on with the Russell. We came up, made a lower high. However, we have not taken out that swing low yet, and so it is not in a short-term downtrend at the time currently, but it still did, it did not push all the way back up into where it broke out above last year's high to an all-time high briefly. And what's it look like it's doing down here? Momentum is pointing down. TSI is pointing down, but not at a real steep level, so that's telling us that there's no real big, huge sell-off. And then the TSI on the weekly, again, rolling over towards the top with negative divergence. Same thing here on the momentum, but no breakdown yet. And so if you get a chance this weekend, if you have an opportunity, go back and pop up with TSI and momentum, and pop up any of the indexes and see how it reacts when you get a crossover of the 883 TSI on a weekly chart. What does the index tend to do? And that will help, as you do your assessment and your evaluation, in the future. It'll help you say, okay, give you a better picture of, or at least be able to establish some expectations of what you think the market is going to do after you get those crosses. And also look for the crosses from the lower side also. When you get the crosses, what tends to happen? What kind of a run do you get? And anyway, that's a good exercise to be able to go through. I know Mike and I, when we're doing our back testing, we're always looking for that type of thing, to see, okay, how's it responding? How is it reacting? And I'll put that up because we're going to talk about that. So path of least resistance. I think the least resistance is basically, to the downside for a pullback. But I could also very well see us next week just doing one of these things where we just move slightly this way to up a little bit. Are we going to, bust out into a brand new rally? I mean, you never know. But with it being the holiday season for trading and all that kind of stuff, I would look for it to be just a little bit muted. But holiday trading tends to also have an upside bias. So we just need to be aware of that it may drift higher. It may actually put in a new high. we'll see. Ultimately, are we going to get a more, the question people, I love it when I meet people, new folks, and they find out what I do for a living. And one of the first questions is typically, well, what's the market going to do next year? And I explain to them, well, any idea, anything that I would say about what the market's going to do next year is merely an opinion. I mean, it may be based on, what the technicals are showing us, but we know that when we get negative divergence on some of our charts, we have the expectation there's going to be a pullback. But in reality, we also know that there are times when the market or the indexes or even a stock can continue to push higher even after it's demonstrated the negative divergence. So the I hope you had a chance to read Mike's article that he did this past weekend that we posted on Tuesday morning. And what it covered was basically talking about, with the current valuations that are in the market and with the bull market that's been going on for almost 8 years, plus the oh gosh, what were the other things? The valuation, the bull market, the employment rate currently, that they are kind of, the unemployment percentage is at kind of a trough, and that often that coincides with when the market decides it wants to top and at least do a nice pullback, and but driving across through 2017 and maybe even in 2018, with all the things that are in place, it may mute the expected returns throughout the year. Now, will there be opportunities within the year where we may get a 10% bounce, a 15% bounce, either way? Sure. But from the beginning of the year to the end of the year, we may just get a lot of noise bouncing back and forth. And so that's something we could look for, going into 2017. We'll see what kind of a profit Mike is. So here's where we finish off the week. We have one more week to basically be pulling in for the strategies. I'm anticipating and looking for a much better performance from strategy 1 because some of the adjustments we've made going into the end of the year. And here's where the our equity curve currently is. So those in future presentations, those of you who are also Bay Area Moneymaker members, we will be doing a webinar on the 29th to close out the year, close out 2016 and be ready for 2017. I'm going to be talking a little bit on that one about what has happened with the first IBD 50 list of 2016. The first training session will be, for premium active trend traders will be the first Wednesday in January. We're going to be talking about how to profit from seasonality. I have also updated the strategy 3. We covered that in this past week's training session. That video has been totally updated and posted to the website. And we're going to be doing some additional webinars or videos about timing entries, refinement early warning system that Mike and I have been working on, and then prepping for the year of accelerated growth. As you can see, there's not a lot to report today. It's been kind of a quiet day. So just want to remind everybody that the active trend trading system, my motto and what I really strive to do continuously is to clarify, simplify, and multiply. I've got a guy working that I'm going to be working with on the website to simplify that moving forward. Going into next year, we're also going to be having a new webinar service that will actually give each member, everybody who logs on, you have a chance to interact with each other, not just, sending me text, messages to be responded to, and so to try to make it more interactive and a higher level quality experience for everybody. But we focus on the 5 pillars of active trend trading: what to trade, when to enter, when to exit, what strategy we're going to use, and what to expect. As I've mentioned several times, I believe that having your strategies built on top of a foundation of a strong system is what's critical. Oftentimes traders get into focusing on individual strategies, but without having their rules and their system in place, and that can be devastating to a person's trading capital. So we try to focus on the basic foundational system and then apply each one of the strategies on top of that. So here's just a real quick highlight. We've been, since we were talking about strategy 3, which is the wealth and income strategy for active trend trading. Here's one of the positions we just closed out on the spiders about 2 weeks ago, and we're waiting to open up a new position in the spiders going forward. Because strategy 3 has done exceptionally well this year, what I'm going to be doing going into 2017 is I'm going to increase the capital allocated for that particular strategy. I'm going to increase it from 20% to 30%. I'll leave 10% for the trading in the directional options, and then 60% of the trading capital be focused on trading, trying to portfolio building based on our current watch list with the a couple of growth stocks and the leveraged ETFs. So, again, for folks who are maybe checking this out for the first time, for one more week we will have our monthly membership going at a 40% reduction, $32.99. The early warning alerts for index ETFs, $3.99, which is 60% off the regular fee of $99, and that's a yearly charge, not a monthly. So if you're interested, you can find more information out at the bottom, or every membership link on the website connects to the discounted membership. So anyway, any questions today, guys and ladies? Again, not a lot really to be talking about going into the 3-day weekend. So, well, with that, I will take a look at a couple of stocks. The 4 stocks I'm paying attention to are in ETFs. I'm paying attention to right now, and so we will see you the first Friday in 2017. I will probably put out just a really brief recording for next Friday. And so, as we say here in Hawaii, as we approach Christmas, Mele, Kalikimaka, and with the New Year's, Haole Makahiki Ho, which means Happy New Year. So keep your egg growing, trade wisely, trade profitably, and we're going to be taking off in just a little bit with the final hour for premium members of Active Trend Trading, and we will progress from there. So I'm going to take a look at a couple of stocks. If you have a couple of stocks you want me to take a look at, I'll be glad to do that also. So if you have a couple of stocks we can take a look at. Here's one of the this is the inverse leverage ETF for the Russell, the IWM, and as you can see, it is basically basing down here, with a low in here at 1855. It busted up through the 8-day moving average yesterday. We had taken a position earlier in this, or on I think on Monday or Tuesday of this week. We had taken a position up at about 1970-ish, and we're anticipating at least a run back up to the 2073 level, pick up a quick somewhere between 5 to 12% before the end of the year. And a question came. Well, I'll be talking about this at the news. So here's one of the stocks I'm looking at. Again, is it buyable now? Yeah, you can either look at a potential purchase now. If it drops below the low of the swing low, that would be about a 4.85% loss. So I would expand that to about a 5% loss would be my stop loss on this particular trade. I'd also go to the weekly chart, intraday chart, excuse me, to take to watch it for a better timed entry. SQQQ, similar type of situation on the daily charts. We've got some good, strong, good support down here at 1232. It's not moving a lot, but even if it breaks up from here up to the 20-day moving average, looking at about 2.59%. Up to the 50-day moving average, we're looking at about 5%. If it gets back up into its area, $14, it'd be 11% gain if it got up to the 15 level. And with each one of these, they move really, really quickly. So it'd be about a 19% move if it got up to the $15 level. Eric, I'm not watching any pharmaceutical stocks per se unless they show up on the IBD 50 watch list. So that is that. What else am I looking at? I'm watching Tesla. As you're aware, if you participate in strategy number 3, we opened, I have a position on this first strategy 3. But Tesla is looking kind of interesting. It is back into at least a short-term uptrend. It has come up and is retesting up here in the 212 level to the 213 level. We'll see if it maintains that or pulls back in to retest the breakout of the trend line. And the position we have for our strategy 3 will be closing up here shortly. Matter of fact, next week, because that position expires in January. And the other one I'm looking at, of course, we talked about Nugget a little bit. It's basing. Is it gonna get some additional strength on the indicators, especially the TSI on the daily? It's looking like it wants to break back up, but it hasn't done it yet. So we're getting some positive divergence there on the daily TSI, and again, momentum has not moved up either. With increased interest rate, gold, I won't say will lag, but people will, are not investing in gold simply because the interest rates went up, a quarter of a percent, gives them another option. The other one I really like is LABU, and it has, it's moved back up through, these past lows, so you could treat it kind of as a shakeout type of trade, but it has not taken out that trend line yet. And so we'll be monitoring that going into next week. If we get a retest down here in the 33 to 32 level, that would be an interesting place if it gets a rebound to go ahead and jump on at least a partial position there. If it and then, because oftentimes what happens with these is they'll rocket back up through the 8-day moving average, and then they'll pull back down, get to a higher low, and then bounce from there. Similar to how it did back here earlier in 2016 in August, pulled down, hit its low, pushed back up to the upper. The black line is the moving average envelope off the 20-day moving average. That's 10% above the 20-day. Bounced back down and then took off again. So shows some, and again, the biotechs have not reversed similarly to how the rest of the market has done with the recent rally, but it'll be fun to keep an eye on. Longer term, what we could be looking at, it is down towards the bottom of the channel we see over on a weekly chart. And so, as I said, if it breaks up through this level, then we can anticipate it running all the way up to the top of the moving average envelope. And in that case, that would be let me get the proper drawing tool here. That would be, if it ran back up to the top of that, would be about a 26% gain on a weekly base. In other words, that would be moving from here back up to about midway of this move, up to about $42. So I'm keeping my eye on this. It's looking very positive given the reversal that it's getting today, but it's not ready to buy exactly yet. But good positive divergence on momentum, support here on the TSI. So Red Hat, RHAT. Let's see how Red Hat is recovering after its earnings. Up. I did it again. There we go. Yeah, Eric, we talked about this, the other day. I think on Wednesday. You get a reaction after earnings, significant fall off. At this particular time, it's got to show me something constructive down here that would be a potential entry if I was going to go with it to the long side. So it's kind of like in no man's land. Some of the things I would be looking for, excuse me, is where's strong resistance, and you certainly have some right there. Excuse me, based on this previous low. And so again, I would give it a little bit more time to figure out what it's going to do, because this was a significant sell-off. I mean, that was one heck of a drop. That was a drop of from the close prior to earnings. That was a 13% drop, and now we're just getting a nice little rebound. But what's this going to shape out to be? Is it going to drive sideways a little bit? It is down at strong support, but we've also got a level of has another level of support / resistance here at about the 70 level. And so that's another thing you be keeping your eye on, is saying, okay, and if you're looking to trade this, if you're wanting to buy it, you can trade it off of these, that level of support there at $70.12 or $70. But then that would also, you'd utilize that as your, kind of your stop if you drop back below it. Down to the low is about 2.26, and so if it undercuts this swing low, you're getting out. So it's only a 2.2%, about 2 to 3% potential loss or potential risk from the $70 level. So, okay, guys, I'm going to call it a day. Again, enjoy the time with your families this weekend, and we will plug back in on the first Friday in January with a brand new year. And again, Merry Christmas, Happy New Year, or as we say here in Hawaii, Mele Kalikimaka and Haole Makahiki Ho. Bye, guys. God bless. Thank you, Michael.